All right, welcome back to the show, Keith Dicker. My apologies. Last time I actually forgot to hit the record button, so we wanted to bring you on once again. And for those of you that are watching that maybe aren't familiar with Keith's work, he's an asset manager at IceCap Asset Manager here in Canada. Which part are you again? Where are you about?
We're in Nova Scotia. We're in Halifax.
Yeah, Nova Scotia. But you've kind of been abroad and have taken more of a global macro perspective. I've read a lot of your work. I initially found you on the Macro Voices podcast. So I've kind of been following along your work for the last couple of years. And I think you're kind of one of the few individuals in Canada. There's not a whole lot of them that have the ability to sort of think outside sort of the mainstream media or the mainstream economics. And I think that you provide a pretty solid alternative view, I suppose, on the global macro economy, and particularly as that pertains to the Canadian economy and to Canadians. So thanks for coming on. And I don't know if you can, basically what I wanted to kind of touch on here is, obviously I'm in the real estate markets, and I never forget when I heard you on your podcast. I think you were saying, like, someone was asking you, I think it was Eric Townsend on Macro Voices, was saying, what your thought on the Canadian housing market was. Obviously it's quite overvalued. And I remember you saying I believe you said to watch the Italian bond market. So I don't know if you can quickly touch on that, and maybe that will kind of frame us into, your view on the macro.
Yeah, sure thing. So, thank you for the kind words. First of all, for anyone who's interested in the investment world, I think it's so much easier today because, without making it sound really simple, but the internet has really just broken all these barriers to entry. So especially with social media today, a lot of people are able to get very close access to, and it's a lot of real interesting managers around the world. And but even before all that sort of accelerating over the last 5 years or so, the challenge with the Canadian investment industry that it's just so completely dominated by the big banks. So you have the big banks, the 2 or 3 big insurance companies and the mutual fund companies, and that's it. So it's a very tight and closed box, and it's just really hard to get outside of that box. And when you're inside that box, you have to walk, eat, and drink just the way that they want you to. So, one of the advantages that I had, which then grew into IceCap years later, was that I was in that box for a number of years with one of the big banks, and it was in the 90s, so that's when it was. But I could see that, hey, the world was a big place. I had this itch to travel, get outside of somewhere beyond Toronto, for example. And so I was able to, I managed to have a great opportunity to go offshore. So I was offshore for 10 years, where I was running a global currency multi-strategy desk. And what that means is we were running money for a lot of very wealthy people who lived in multiple countries. They had multiple currencies in their pockets. And they looked at everything, including equities and fixed income and beyond. So hedge funds, private equity, commodities, currency, you name it. And the name of the game was always to view the world not from any home currency bias. So if we were in this little small island offshore and home base, you're living with a bunch of expats and your clients live from all over the world. So you're able to see things differently. And also what these guys want to do, they want to try to avoid losses as much as possible. So for long only strategies, that's what we focused on. So fast forward today, we are coming back to the Italian market and the Canadian housing market, by the way. But with that experience then in my pocket, that gave us then the foundation to launch IceCap. It was 10 years ago now, and manage our portfolios using a global macro perspective, which really means we're allocating across markets. That's simply what we're doing. In addition to equities and fixed income, everything else. And so we've had a lot of success with it. And a lot of our success, though, has been attributed to, writing and talking and walking and how to view the world differently. So in Canada, at the time, there weren't a lot of shops that were able to do that, and I think it's mainly because they were trapped in that that big bank box, I call it. And so that's how we managed to get some exposure. Now you saw us from chatting with Eric there a while back. So I think the one thing that Canadians need to appreciate is that, as great as Canada is, and on so many different fronts, in the financial world, economic world, political, you name it, we are, we are not controlling the world. We're a very small piece of a big puzzle. We can't influence it in soft ways, but other markets will influence our domestic markets, whether it's financial markets or any other terms from a policy perspective. So back to the Canadian marketplace, you're in the housing, real estate business, and we are too, directly and indirectly. People say, okay, what's going to cause the Canadian market, to experience stress? And at the time, I said to Eric, and I said to other media sources as well. So listen, most likely the event that will create stress in the Canadian marketplace will come from outside of Canada. And that's what I meant by, hey, we need to watch the Italian market here, because as soon as we get a financial event or stress re-escalating in any of these markets, the banking and financial system and debt issuance system, everything is tied together. So the correlations go to one. And as soon as something happens in one market, it could very quickly spread to another market. So, with the Canadian real estate market today, the primary reason why it's incredibly strong in a lot of different places right now is because the Bank of Canada, with their policy actions, it is suppressing the global yield curve, which effectively means the price of borrowing money is getting lower and lower and lower. So when you have that market environment, it's pretty cheap to lever up, because housing is the biggest levered asset that anyone can have.
Yeah, that's which kind of gets us on our next point, because you're looking at it from the global macro perspective. As you mentioned, you're allocating cross asset, and it's obviously counterintuitive to, I think, most Canadian portfolios, which is long real estate in Canada and long the Canadian banks, which is essentially the same trade. So basically doubling down on that. And then we're looking at it as, it's obviously a function of low rates. Obviously, the Bank of Canada, throughout this pandemic, their balance sheet, they didn't really engage in any QE back in the financial crisis. But, since this pandemic's unfolded, their balance sheet's up 350%. I think as of right now, they own 35% of the bond market in Canada, which, again, it's a small bond market, right? So my question to you is there a tipping point? So they're saying, based on the Bank of Canada's current projections, which is, they just scaled it back from $5 billion worth of government bonds per week to $4 billion worth of purchases. But based on this rate of purchasing, by this time next year, they'll own about 50% of the government bond market here. Is there a tipping point where the Bank of Canada taps out? Because again, it's a small central bank. It's not like the Bank of Japan, where you can basically buy every single piece of debt instrument out there. It's Japan versus Canada. So I'm just trying to. Do you have any thoughts on that?
Yeah, I have lots of thoughts on that. Well, first of all, Jerome Powell, so that the chair of the U.S. Federal Reserve, he said a few weeks ago. So I'm a central bank groupie. I just appreciate these guys for what they're trying to do, and it's never for us to agree or disagree with them, because you can disagree all you want, to agree all you want, but nobody cares what Steve thinks they should do, or Keith or IceCap. So you always said to look and you appreciate what are they going to do. And in my mind, they've been incredibly transparent what they're going to do. So even a few weeks ago, someone was giving pushback, to Powell at the U.S. Federal Reserve. I forget the question, but he sort of looked at them and said, it's not as if we're going to run out of money. They're just, they're creating it. Now we can talk about, what's money, what's currency, and the monetary base, and all that stuff. But the point for the average person to understand is that we are now literally it is a point of no return. And what I mean by that is, again, come back to the Bank of Canada and the Canadian economy is not operating in isolation. It is not on an island. And we, as the Bank of Canada, they cannot do whatever they want. They toe the line, absolutely. They do what they were told to do. Mostly, the Americans, they have the reserve currency. They have an incredible amount of financial power. If people think they don't, and they think that, they're going to devalue the dollar and all, they just don't understand the way everything is put together. The Americans run their show. So the Bank of Canada is falling in line. I'll show you a good table here, a good matrix in a few minutes, and how everything fits together. But with the Bank of Canada, so they have another meeting coming up on Wednesday. I think we are the 9th. Yeah, it's on the 9th for the Bank of Canada. At their last meeting, they had presser, and they came out with two, I thought they were very significant answers, responses, announcements. One was answering a question, the other one was they just volunteered it. So first of all, one of the, they said, hey, we're not going to increase QE. So this is quantitative easing. They said, we're not going to increase that. Instead, we're going to shift it. So instead of buying short-term bonds that Ottawa is issuing, we're going to shift it off the yield curve and buy more medium and long-term bonds. And I say, wow, I always ask why. Why are they doing that? And I know the answer. So the answer to that, which carries over to the housing market, is that they cannot tolerate long-term rates going higher. So as you know, just say you're pre-approved, or you have a soft approval form, say, what's the Vancouver market? Say $1 million for a mortgage in Vancouver, which will get you whatever you will. And say the rate is 1%. And then say that financial accident happens in Italy or somewhere else. And all of a sudden that 1% mortgage, say now it's 2%. You find the condo that you like, and you run back to the bank and they say, hey, we found our dream home. We're ready to take that mortgage. And the banker says, oh, that's great news, fantastic. Oh, by the way, rates have doubled from 1% to 2%. We can't lend you $1 million anymore. Instead, we can only lend you $940,000. You say, yeah. Wow. So that's a 6% drop in price for that condo that they're going to buy. So again, just demonstrating that the Bank of Canada, they're very aware that the moment long-term rates go up, it's really going to hurt the housing market in Canada. But on the flip side, it's also going to hurt the federal government from borrowing, because they'll have to allocate more money.
I think corporations in Canada are extremely levered too.
Yeah, I mean, when you have 0% and 1% rates, I mean, it's you should be borrowing. I mean, it's the way monetary theory works. But the other challenge with it, of course, is that so we're trained in school. I was actually at a Bank of Canada meeting there about a year ago or something, and I asked a question, basically about socializing the bad debt problem. I got a little bit of pushback on it, and the response was, hey, low rates are good for everyone. And everyone there, they all nodded their heads. And I'm looking around, I said, that's not true at all. I said, my grandmother, who wants to put her money in a GIC, you tell her low rates are good, she's going to say, no, it's not. So a lot of people, as a big percent of the population, they used to live on 4, 5, 6% GIC rates, and they had quite comfortable lifestyle doing that. But remember, they're taking on zero financial risk. All of a sudden now that rate is at what, half a point, quarter point on a GIC? I don't even know what they are anymore, truthfully.
Yeah.
But there's always two sides to that financial coin. It's the guys that are borrowing, and the guys that are saving. So the savers, their money goes into the bank, and then that's sent out then on the other side. So this low rate policy by the Bank of Canada is tough. And then the other comment they made at their meeting as well, and they weren't even cued on it; they just volunteered it. And again, you always got to listen to what they say, how they say it, and why. And they said, oh, by the way, negative rates is in our toolkit. But look, there's no way we're going to use it. We don't see any reason possible why we would need to use negative rates in Canada, but they're in our toolkit.
Never say never.
Yeah, so just by volunteering that, they're going to go negative. I mean, they're absolutely going to go negative in Canada. They've gone negative elsewhere already, and so Canada, has been late to the game in terms of using unorthodox monetary policy, because justifiably so, the economic data hasn't supported them being super aggressive. But they're monitoring fiscal response back in March. I mean, they were more aggressive than any central bank out there and any fiscal government out there as well. So like, I love anecdotal stories, right? Because, we can go through data points all day long, and they're always a good bit of fun. But sometimes anecdotal stories are good as well to give you perspective on things. So there a few weeks back, I was chatting with one week, two different currency managers. Another one was Canadian based, one European, another one is out of New York. And the guy in New York, we're chatting, and he pulled up his heat map that he had for, countries and factors, and, you can picture it that way. And I remember looking at him, and I'm sort of peeking around his shoulder, sort of on a Zoom call. And I said, show me your matrix there. Which country is in all red? He said, oh, that's Canada. I said, why is that flashing? He said, there's so many different levels that gives him cause to be concerned about the Canadian dollar relative to all other currencies. So, but like everyone has known that for a while, and until it happens, it's not a risk, right? That's just the way it works out. But again, just to demonstrate that when you look at it domestically from the inside out, there's some things that are stretched here in the country. And even external managers, they're looking at the Canadian marketplace, and they're shaking their head as well.
Yeah, exactly. And that's kind of, the Bank of Canada has basically told us like everything they're going to do, right? I mean, they talk about negative interest rates being in the toolkit. I mean, they've talked implicitly about yield curve control, because I always get this pushback, when I put out, some content or video or whatever, and people always seem to get very emotional about what the Bank of Canada is doing. And they say, well, morally, it's not right. They can't continue to go on. But I don't really care, again, morally, what is right or wrong in terms of this. It's out of my control. All you can say, listen, is that they're implicit, as you said, they're implicitly telling you what they're going to do. There's 0% of society or of the Canadian economy that can actually withstand rising real interest rates. And so the de facto playbook is, again, as you mentioned, it's either negative interest rates or some variation, some form of yield curve control. And I think that's implicitly what they're doing. But by purchasing on the longer end of the yield curve is basically to help influence mortgage rates, because that's the largest component of, I mean, it's probably the backbone of our Canadian economy. I think it's a terrible way to build your economy and your society, but it's gotten so large now where you have to continue to come in and support the housing market. So it's almost like a Ponzi scheme that must continue, otherwise things basically blow up.
Yeah, and again, it is what it is. That's just the way it's structured here in Canada. But the same thing in Australia and the UK for a long time as well. Like a lot of markets, you become, because remember, ever since really the early 80s, interest rates have gone from effective 20% straight down to zero. That's where we've headed. And whenever you have long rates go from 20 to zero, like it's so easy to make a lot of money. Like it really is. And now back in 2010, after the great financial crisis, we should have started, swinging back up then, and that would have solved a lot of challenges in the world. But instead, that they flatlined everything. So they kept short-term rates at zero using QE. The Europeans went negative in 2012. They held Berlusconi hostage overnight in Italy to get the Italians to come on board. Like a lot of things happened that you don't see in the headline news, but once you dig deeper and deeper, you say, "Oh wow, okay, this is pretty ugly underneath here." But again, like it is what it is. So then you say, "Okay, what's going to happen next?" Because if you say,
what is the end game?
Yeah, and I think we're going to be 75% correct how this eventually plays out. As for the timing, that's always a challenge. But if you make the assumption that the only way to return to a normal functioning economic cycle is that growth has to accelerate, so the acceleration is enough to produce additional incremental tax revenues to not only pay for that additional interest burden we have coming out at the federal government level, or even households with credit cards and mortgages and all that. Because remember, if you're on a 5-year fixed rate or a short-term variable or something another, if the economy starts improving well enough, eventually that rate's going to go up. and it becomes an exponential increase, on your household income, like a taxing on you. So the only way for that to happen is have the growth, to absolutely accelerate around the world. But yet that's not happening, especially if you look at what's happening now this year. I know we have the pandemic, of course, that's happening. But if you look at all the economic data points on a global basis, and especially in Europe, everything is now starting to roll over. Like it's getting a little bit weakish again. So again, I don't know how we get to a point where growth just simply takes off again with exponential growth. So I mean, the kind of growth you're looking at 3 to 5% a year in real GDP growth, and it's just going to be a real challenge to get there. So if that does happen, then okay, we will have other challenges, and we'll get through it. If it doesn't happen, you're going to make the assumption that hey, the yield curve will stay flat to low right across the yield curve in all countries. And fiscal policies just running rampant. Like here in Canada, for example, was it 400 billion deficit we have this year? I think that's the number.
I think they're saying 400 to about 450.
Oh, 450! Wow.
Yeah, it's still going.
I remember 5 or 6 years ago when the election was here, and the Liberal Party came to my door canvassing, and they're talking about the soft points, and I said, well, what about the deficit? What deficit are you going to have? And they said, finally 4 of them came over, and they said, yeah, we're expecting a $2 billion deficit. And I said, I'm not going to have $2 billion, no way. So it ended up, I think that year at 20 or 25 or something, and now we're at like 450, right? It's just an incredible number. And again, when they say that, the reason they can say that, they can say it with a straight face, absolutely. And you and I can look at them and say, oh, wow, that's crazy. You shouldn't be doing that. But they'll say, hey, the market is telling us we can do it. So again, you go back to, you might disagree with it, but the point is they're doing it. And as of right now today, the Canadian dollar and Canadian bond market and equity markets, nothing is showing the federal government that they're being penalized for going this $450 billion number that's coming up. So then we look at it and we say, okay, the Canadians are doing it, the Americans are doing it, the Aussies are doing it, the Brits, the French, the Germans, the Italians. You just keep going down the line. Japan as well, and the Chinese. So
Japan, I should add, at the time of this recording, the Bank of Japan is now the largest shareholder in Japan.
Yeah, no, yeah. which
holder of equities. So.
Yeah, so that again, like it ties into the whole, like, how does this play out? So, like, if you're an equity holder in a company, you have shareholder. You do everything for the shareholder at the end of the day. As soon as you have the central bank, being a shareholder in a company, and all of a sudden, then the way the world will sort of swing a little bit now towards one side or the other. All of a sudden, things will start shifting more towards a stakeholder. So then corporate decisions will no longer be made to maximize profit for a company. Instead, they'll likely be, nudged to push to coerce or whatever, to try to maximize value for society. And so the Japanese are there. I mean, that's where they're going. But one of the big things you're talking a lot about now is, guaranteed basic income. You're also hearing about central banks going with a digital currency. You have that out there.
So the Bank of Japan has essentially nationalized the bond market and essentially these large corporations. By being the largest shareholder, you've essentially nationalized the entire financial market.
So eventually, we have this huge debt problem in the world. And so at the sovereign level, like a lot of people say, right, they're just going to write it off or cancel it. You can't do that. So if, just say the federal government in Canada, say they decide all of a sudden, you know what, we're going to cancel all the federal debt. And, hey, that's great. We have more tax revenue to do this or that. Remember one person's debt, remember the saver borrower example we used earlier? So all of a sudden now, if you cancel all the federal government debt in Canada, all these pension funds, they go under. Like instantly, they just go down 30%. And all of a sudden you look at the banks, all of a sudden they're gone under. Their entire regulatory capital, I mean, that's all in federal debt as well. And then you're left with corporate debt. And as you mentioned, like the Canadian corporate bond market, it's non-existent. Like it's so, that's why if anyone in Canada, if you want to invest in say corporate debt for your retirement portfolio, you're effectively buying an American corporate bond portfolio with a currency overlay, because it just doesn't exist in Canada, right? There's not a lot of issuance available. So we're running into these challenges here. And then the central bank's talking about a digital currency. What that really is instead of putting your money on deposit with one of the big banks, put it on deposit with the central bank. So all of a sudden now you have no credit risk.
Right.
So you say in Canada, Canadians say, oh, who cares? It's not a big deal. If you're over in Europe, and let's just say you're in Italy and your money is on deposit at the ECB instead of UniCredit, and all of a sudden you hear the rumor out, UniCredit's going under. You know, there's no bank run now.
Right.
Who held that? Yeah. Why would you keep your money with UniCredit when you can put it up at the ECB instead? So then that's going to put a lot of pressure on banks then, because then they just become, you know, they'll be levered entities, you know, lending to markets, which is what they were meant to do originally. So then all of a sudden, then, you know, the risk with holding bank shares, you know, it does come back to shareholders. Because right now in Europe, for example, if any bank really experiences stress, you know, they'll get bailed out. I mean, that's effectively what will happen. So, you know, we're moving to some, you know, odd, peculiar moments coming up. And, you know, the system has been, you know, really stretched, you know, to the nth degree. You know, one thing we talk about quite a bit, Steve, is we talk quite frequently that there's a collision taking place between financial, economic, monetary, political, and social factors. So like everything is just coming together at the same time. And when it hits, like, you know, things are splattering all over the place, and, you know, we're all trying to figure out, you know, what to make of it. But again, we're at this moment of time in the financial world where we have, you know, zero negative rates. Again, central banks are talking about creating a digital currency. Governments trying to figure out what to do with all their debt. You know, do they cancel it? Do they, you know, make it, you know, do they extend the maturity on it, chop the coupon in half? You know, there's all kinds of things that are being discussed. And yet at the same time, you have a lot of people are unhappy from a social perspective. You know, following the story about the guy in Ontario with his restaurant, he was trying to keep it open, you know, with the pandemic lockdowns or soft lockdowns happening. Same thing across the US, you know, Paris was in flames on the weekend. You know, politically in the US, that's still not sorted out, and it won't be, you know, for a while. So all these things have an impact on financial markets and economic growth. And then because of that, you're getting a policy response from that.
Yeah. I mean, I think you're seeing that more and more of that, you know, wealth inequality, that social friction from all these policies, right? As you said, I mean, there's for every action is kind of a reaction. And I think these, you know, zero negative interest rate, pump up asset prices obviously is creating this massive wealth divide. I mean, you talked about digital, central bank digital currencies. I think that, to me, it seems like it's pretty obvious that it opens up the door for some sort of modern day debt jubilee. And as you mentioned earlier, I mean, I think if you don't get through, if you don't get the ability to grow out of it, so you don't, you know, GDP doesn't accelerate, maybe all the debt and the demographics just simply can't overcome, you know, all this fiscal spending, and you still get sort of deflationary forces and you can't grow your way out. I have to think that there has to be some form of debt jubilee to show a clean balance sheet.
Yeah, and again, like debt jubilees are, as I mentioned, one person's debt is somebody else's asset. So the moment you start canceling debt, again, someone else's asset, you know, gets eliminated. You know, there's a way around it, of course. You know, in Canada, let's just say they want to eliminate the federal debt. The Bank of Canada would say, "Hey, we're buying all the debt." So they press a few buttons and they buy every single federal bond that's available in the marketplace. Canadian dollars back into your account. As soon as the Bank of Canada receives it, you know, they'll cancel it, whichever way they need to do that. But now as a pension fund, all of a sudden, you're sitting on, say, anywhere from 15 to 25, 30% in cash.
Mm-hmm.
So what do you do next with that? All of a sudden now the consultants, they were running the pension fund industry. They sit back and they say, okay, well, we don't know what to do with this now. This doesn't fit into any of our models. Are we going to buy equity with it? And then you go, like, for example, if any treasury department for any Canadian company, what they're holding in cash is, they have it on federal debt usually, whether it's in T-bills and stuff like that. So, it's not as simple as this debt jubilee. The other thing that's always interesting as well, if levering up and going with zero negative rates and any other of these strategies they can use, if that is so awesome and that's going to restore the world back to, to tip it back into a growth environment. Japan's been doing this now for about 25 years. It should be the fastest growing economy on earth. They should have inflated away all of their debt, and it should be the most envious economy in the world. And it isn't. It isn't by a long shot. Instead, you have a zombie financial sector. Same thing with Europe. Europe's now been in zero negative rates for 8 years running. If that was so awesome, they should have no social unrest. Italy should be just taken off because of their current account surplus is so great. And again, none of these things are happening as well. So, there's a lot of holes out there. The first thing you do if you're digging a hole is to realize, hey, I'm in a hole. Got to stop digging.
Yeah.
Pull yourself out of it. I just want to share with you, this is a matrix that we put together just so people, especially here in Canada, you can better visualize where the Bank of Canada is relative to everyone else. And then we can sort of just dance around a little bit so you can see how, why the Bank of Canada is doing something and what the response could be.
Yeah, let's do it.
Okay, let's see how we do. Can you see that there now, Steve?
Yeah, you can see it. Yeah, Global Monetary Policy Matrix.
Okay, cool. Let's work off this. So what I want to show here for everyone, these are most of the larger central banks around the world. If I missed one, it's not intentionally. We have Canada there in the rectangle, so we can use that as our base. And however, just to share with you from an investment and management perspective, everyone in my world, we actually shift that black rectangle over to the US side, because it is the world's largest economy, it's reserve currency and so forth. Because remember, all these other names here, they're all making decisions not only relative to each other, but relative to the US as well. So the first thing we're going to look at here, okay, what's red right across the board? So in the first column, factor and country, this is really the toolkit. And so we made sort of subjective decisions on where everyone is, but with zero rates, everyone has already gone to zero rates. That's where we are. Negative rates, we can see who's left to go negative. So Canada is there. So if things do not improve from an economic perspective in Canada, or even more importantly, even if things remain stable in Canada over the next 6 months, but Europe really begins to deteriorate, Asia deteriorates, and so forth, the Bank of Canada will still go negative because they know, they say, wow, we're fully exposed to the rest of the world.
Yeah.
Bank of Canada, they're already buying debt, federal debt as well as provincial debt. They bought a bunch of mortgages from the banks. It's ironic. You probably saw the article in, I don't know, was it Bloomberg or Reuters?
Bloomberg, I think.
Was it? And they said, the banks are flush with cash. They're going to want an M&A spree. What are they going to buy? And, they might want to look at buying back the mortgages they sold to the Bank of Canada earlier in the year. But we know that's not going to happen. So that's there. But when we look around the world, remember the purpose of going to zero in negative rates and quantitative easing, YCC's yield curve control, forward guidance, it's all meant to stimulate the economy. And they've reached the end of Keynesian economic policy. and nothing is working because we're not getting this. There's no acceleration, no escape velocity for the economy coming from any of this. Trying to create inflation, it's a bit of a misnomer as well. What they're really trying to create is wage inflation. That's what they want. Other kinds of inflation it's not good for any of us. But anyway, that's there. So we look at this next and we say, hey, well, what's up next? And I think we're going to start moving towards this explicit, currency devaluation. I mentioned earlier, Bank of Canada's meeting on Wednesday. We got the ECB on the 10th, so it's Thursday. A couple of weeks ago, maybe 3 weeks ago now, Christine Lagarde, the head of the ECB, she explicitly said, hey, we're going to have a bazooka coming out of their next meeting. And I was like, wow, that's exciting, So like if Keith or Steve used the word bazooka, then that's pretty traumatic, and people forget about it the next day, right? If the head of the ECB, announces we're going to launch a financial bazooka, you need to take notice of this. So then you can just look at the Eurozone column here. Okay, they're already at zero rates, they're at negative. Can they go with a deeper negative rate? Yes. Will that have an impact? No. It's had no impact now for 8 years. Can they do more QE? Yes, they can. Would that have a big impact? No. Again, it's doing the same thing, over and over again, expecting a different result. They also have it used to be called the Vitro, but it was a program where they would lend to the banks pretty cheaply, and then they would have to lend it out. Can they do that? Yeah. Is that going to be a big boost? Again, it's no, because it's already happening. Can they buy equities? It's not in their mandate, so that would be a pretty big jump for them to do that. So what's left for the ECB on Thursday is to start talking about FX. 2 meetings ago, they got cornered and they refused to talk about it. That's when euro was around 116.5, 117. And then at their last meeting, euro was punching through 18.50, I think it was. They finally came out and said, yeah, we're not quite happy with the exchange rate, and it came down. So now we're looking at euro at around 121 and a quarter, and so that's even higher than we were 2 meetings ago, 1 meeting ago. So we think there's a probability here that they could come out and finally say, what, this rate is a bit high, too high for us. We're trying to export our way out. Of course, that will go against what the Fed is doing.
That's the thing, though, right? It's like if these guys, if the ECB fires the bazooka, and they implicitly, as you said, explicitly devalue their currency, well, then it's essentially like a race to the bottom, and everybody else has to essentially fire their bazooka. So then the U.S. has got to come out, because then U.S. dollar strengthens. They have to fire the bazooka. Japan's got to fire everybody's got to fire the bazooka, and so you're basically just it's the race to the bottom, and it's like it's a race that you don't really want to win.
Yeah, absolutely. So like just to say now we're being a bit dramatic with it all, of course, but again, we're just trying to be practical. What can they do? I think for all intents and purposes, the bazooka will not be a bazooka. It's just going to be a thud. But if they do a bazooka, this is one of the big things they can do. So if the Europeans do it, by default, the Swiss have to fall in line as well. Because the Swissy, the Swiss franc, Swiss dollar, that is pegged to the euro. They had to do it. If they do it, all of a sudden the Bank of England are saying, "Oh man, we got to do this." Right?
Yeah.
And the Japanese are saying all of a sudden, because you think the dollar would appreciate, the U.S. dollar would appreciate, the Japanese yen will go through the roof if this happens, and the Japanese are going to say, "Oh, like this doesn't work for us." And then the Bank of Canada, they're saying, "Oh man, we just had our meeting yesterday. Which we got to do another meeting, right?" So what are we going to do? And the same with the Aussies. It just becomes a pretty tough. As I say, it's a relative game out there. But again, it's like this. The objective or the goal of this matrix is to show to people that it's a global world. Canada does not operate in isolation. And then the move by one country can have a pretty severe knock-on effect on someone else. But we really are at this game where we're at the zero floor, zero bound. So it's again it's incredibly interesting where we are.
No, absolutely. I think that was a good sort of rundown breakdown. So we've kind of analyzed everything that's happening in Canada, but globally with all the the central banks and fiscal policy, et cetera, et cetera. How are you, just to sort of summarize and I guess, get closer towards wrapping up here, but you take on all of everything that you've said here today. How are you, advising clients, or how would you advise any of the viewers here? Not obviously financial advice, but like, I suppose what is your ultimate view, and how do you sort of hedge that?
Yeah, so first of all, we're global macro. So by default, global macro. The future doesn't look great in the global macro world because of all this stuff we just shared with you. So we talk about that, and it's easy to talk about because it's just like mountain climbing books. There's no mountain climbing books written about the guy that went to the top with no incident whatsoever. There has to be something bad along the way, right? But what I'm sharing is that we do see a lot of potential for risk in markets coming up. But if you have severe or escalating risk in one market, it means there's a mirrored market out there somewhere else that's going to give you a good return from that. So just because you're at IceCap, we can be pessimistic and dark sometimes about what the outlook might be from a monetary perspective. We still have a very healthy allocation to equity markets. So we're not at a 0% weighting. We're not short equities. We have a healthy allocation. And people say, well, why is that? And the reason for that is because, as people will realize by now, financial markets can be disconnected from the real economy for a long time, and the divergence can be quite extreme. And that's where we are right now. So for investors out there, this is us. For your listeners, we don't know what they need to do for themselves. But we do have a healthy allocation to equities. We're not afraid of equities. We're not in love with them. We don't have a strong dislike for them either. But we do read those markets, frequently, and we are aware that they can move that direction. However, the markets that we dislike, it is the bond market. We think there are very few opportunities in the credit market world. So corporate bonds, high yield bonds, credit spreads now are at their all-time tightest spreads again. It's a classic asymmetrical risk return opportunity. Your upside is this, and your downside is that. So we don't like those kinds of relationships. On the flip side of that, a market that we quite really are fond of is really the interest rate volatility market. Mm-hmm. So we have about a 15% exposure across our portfolio as to bad things happening in the bond market. So if inflation expectations change, we make money on that. If volatility in the bond world increases anywhere along the yield curve, we make money on that. Because of the way the central banks have been set up with monetary policy, we think the probability of that world happening is quite high. The probability of it not happening is quite low. So it's that opposite asymmetrical risk return opportunity. Mm-hmm. So again, we want to be long or have a healthy exposure in those markets and less exposure to others. And, we haven't run away from equities. So I guess that's the main thing to look at. Longer term, we think there's going to be a great opportunity in, say, some of these agricultural commodity markets. And that's mainly you're looking at from a supply perspective, same with base metals and things. So again, there are a lot of great opportunities coming up in the marketplace. We have to be patient, and have the vision to see which way we swim around here.
Yeah, no, absolutely. I mean, I think that's the perfect way to end it a little bit. So Keith, anyone that is interested in your services or just wants to hear more or even read any of your research, what's the best place for them to find you?
Yeah, they can find us on Twitter, it's at IceCap Global, or they can find us on our website, which is icecapassetmanagement.com. And so we manage money for people across the country. So even though we're tucked away in Nova Scotia and Toronto as well, it's funny. I was chatting with a client in Vancouver a couple of days ago, and sort of, how's the weather? And, my client there said, oh, it's lovely, nice blue sky, pleasant day out walking around. What's it like there? And I'm looking outside. The rain was hitting the window. I couldn't see across the street with fog, but the foghorn was on. And I said, oh, it's a typical, maritime day.
You have to come visit here sometime.
Yeah, absolutely. Well, thank you for your time. I love chatting together again, and it is a small world. It really is.
Yeah, no, it's a pleasure. It's always great to have a couple Canadians on here and hopefully share some insights with the viewers. So, again, thanks a lot, Keith, for coming on, and look forward to chatting again soon.
Okay, great. Thanks, Steve.
Awesome.